Janet Yellen, the chair of the Fed, has been speaking today to the Economics Club of New York, a big set-piece speech on monetary policy. Our US managing editor, Gillian Tett, was there on the podium behind her in a set that looked really quite a lot like an old-fashioned Soviet presidium. Gillian, what did you make of that piece of economic theatre?
Well, Chairman Yellen's address was indeed a piece of ritualistic theatre. It was the 452nd meeting of the New York Economic Club. This is my menu with scribblings all over it.
Right.
And it is very, very ritualistic. And she was there to really reassure. She knew she was speaking to the creme de la creme of the New York financial policymakers and traders and investors and to the rest of the world because it was broadcast more broadly. And it was all about trying to convince people that the Fed knew what it was doing, it was standing ready to react to whatever the global economy could throw at it, but basically steady as she goes.
Now, I totally agree that that was the message she wanted to get across. I counted the word stabilize 7 times during her remarks. I, however, was somewhat nervous that she seemed to think the situation was worse than many of us watching thought it was, at least here in the US, where the economy is showing some signs of strength. And that she might have overdone the dovishness. Was that the impression that you got?
Well, there were 2 red flags. One is that she clearly indicated that international economic conditions are more worrying and destabilizing than they had previously expected. No surprise there, given the oil shock, the China shock, the geopolitical tensions. Secondly, she pointed out that although some indicators in the US were much stronger than people had expected, primarily to do with domestic consumption, the manufacturing side, the industrial side, the exporting side was suffering. She also pointed out that inflation expectations have fallen quite noticeably recently, although she questioned just how reliable the data is. So the overall picture was actually pretty dovish.
Yeah.
She argued that actually the negative developments in the global economy were being offset because markets had repriced the chance of a Fed hike, and so essentially market-based rates had fallen and therefore were more accommodative than before. But it was not certainly anything other than a pretty dovish picture.
Yes, which, as I said, really took me aback, the extent to which he felt the need to do this. Is there a risk that this is going to show signs of discord within the Fed? Because we'd heard a number of governors in the last week trying to row back, or that's what many of us interpret them as doing anyway, trying to row back the very dovish message we got from the last FOMC.
Clearly there are a variety of views inside the Fed right now. And one of the very interesting things is the difference in views among the Fed governors about the degree to which the markets are doing the work for them. Yeah. Because the picture of the markets that Janet Yellen presented today was essentially self-correcting. Yes. If markets become scared about the outlook, they basically cut market rates and provide more accommodation for the global economy, and so everything's fine again. But that only works if markets think that actually the Fed overall is dovish. She certainly achieved that today, looking at market prices and how they moved. But it's a very open question whether the Fed can be this carefully in control of events as it wants going forward.
Yeah, there was something almost Greenspanian about the degree of faith she had in the markets as a stabilizing mechanism. Now, one other point that intrigued me was she wanted to talk about asymmetry, that she said it would be much easier for the Fed to catch up if inflation catches on, moves upwards, than it would be for the Fed to deal with things if they raise too soon and we stagnate. One other point that intrigued me was that she then gave the list of things they could do in that situation, and it very, very clearly did not include moving to negative interest rates. What was she trying to get across there?
It was quite remarkable. I mean, she took great care to point out, one, that there was this asymmetry. It's easier for the Fed to crack down on rising inflation expectations than to combat falling inflation expectations. And secondly, she said that although it would be harder for them to combat falling inflation expectations, she didn't mention the word negative rates once. Quite remarkable. No surprise perhaps, because the economists I was speaking to in the room and up on the dais with her, aside from agreeing that it was a very dovish speech, they all said, well, yes, the evidence so far is that negative rates in places like Europe and Japan have proven to be very problematic. And so although people have been playing a thought experiment in recent weeks about should we, could we, can we imagine a world where we introduce negative rates into the US, my judgment is actually the consensus is moving away from that in terms of it being a good idea or not. And the fact she didn't mention it at all was striking.
No, exactly. It's almost exactly what the market wanted to hear. Dovish, but no risk of NERP.
My judgment is, on the basis of that speech, I wouldn't expect the Fed to do anything more this year. Maybe one gradual rate rise towards the end of the year, but certainly it's a steady as she goes message, or sit on your hands and wait and hope.
And that's exactly, intriguingly enough, what the Fed funds market is currently telling us to expect. Gillian, thank you very much indeed. There will be an awful lot more, rest assured, on this on FT.com later on.